Hello, everyone. I'm Bill Mayhew, a professor of accounting here at Duke University's Fuqua School of Business. I'm happy to join you today as part of Fuqua's LinkedIn Live series that comes to you the first and third Wednesday of each month at 12:30 p.m. Eastern Time. Our session today will go until 1 p.m., and my plan is to present for roughly 20 minutes and take your questions for the remaining 10 minutes. Please post your questions to the comments section at any time. You do not have to wait until my prepared remarks are over to ask a question. So by way of background, my general research agenda here at Fuqua investigates how managers of public corporations communicate with the financial market. Managers can communicate via what they say in public and by the numbers they provide to the market in their accounting reports. I've studied issues ranging from how managers sound when they talk, how they mistreat financial analysts who are negative about their firms, to how well auditors can detect fraudulent accounting numbers in financial reports. Today, I'll be talking about oversight over financial reporting by the Securities and Exchange Commission. I'll be summarizing key findings from a paper I recently published in the Journal of Accounting and Economics titled State Sponsors of Terrorism Disclosure and SEC Financial Reporting Oversight. This paper is co-authored with two recent Fuqua PhD graduates, Matt Kubik, who is now on the faculty at the University of Texas, and with Robert Hills, who is now on the faculty at Penn State. So before getting into any specifics, let's first note that in academics, broadly speaking, there is interest in understanding the boundaries of SEC oversight. That is, what are the sorts of things that SEC should be especially concerned about reviewing in public filings, and which things should they not be so worried about? Scholars in accounting, finance, law, public policy, all of us are interested in various aspects of this general question. The specific aspect I will discuss today pertains to the SEC's interest in disclosures pertaining to state sponsors of terrorism, or SST for short. The research question we seek to answer in our paper is as follows. Does SEC effort to regulate state sponsors of terrorism disclosure limit financial reporting oversight? There are three key parts to this question we need to unpack. That is, what do we mean by one, SEC effort to regulate? Two, what do we mean by SST disclosure? And three, what do we mean by financial reporting oversight? Let's talk about all three of those. So first, to understand what we mean by SEC effort to regulate, we have to think about how the SEC is set up. Within the SEC, there is a division called the Division of Corporation Finance. The Division of Corporation Finance selectively reviews filings made under the Securities Act of 1933 and 1934. And the review is designed to assess compliance with applicable disclosure rules and accounting rules. And so the SEC is looking for deficiencies when companies file their financial reports and other disclosures with the Securities and Exchange Commission. Okay, now that we know how the SEC is set up, what do we mean by SST disclosure? State sponsors of terrorism is a designation that the United States Department of State gives to countries. The list of SST countries in our sample included Cuba, Iran, Iraq, Libya, North Korea, Sudan, and Syria. So essentially, the SEC is interested in ensuring that an investor is informed about any instances when a company is engaged in business with a country that's designated as a state sponsor of terrorism. Let me illustrate how the SEC exerts effort regarding SST disclosure. So when the SEC reviews filings like a 10K or a 10Q, if it thinks there's a deficiency in disclosure, they will send what is called a comment letter to the corporation who made the filing. And then the company will respond back to the SEC to answer the question and, if applicable, update their disclosures. So here's an example. Everyone knows the toy maker Mattel. So the SEC sent a comment letter to Mattel with the following sentence in it. It said, "We note a 2012 news article reporting that shops in Iran were selling Barbie dolls." And so Mattel received that, and they wrote back to the SEC and said, "Mattel's records show no sales by Mattel or any of its subsidiaries of any Mattel products to any person or entity in Iran." So what we have here is Mattel responding back saying, "We don't have anything to disclose." The SEC asked the question, Mattel answered and said, "We've got nothing to say." So that's an example of the SEC going after an SST disclosure, if you will. Now, that Mattel example is just one example of the SEC looking for any sort of data that suggests that there might be a clue out there that a firm is not appropriately disclosing information about SST transactions. And so instead of the news article in the Mattel example, here's a different example. Everyone knows the company DocuSign, where you electronically sign documents. So the SEC sent them a comment letter and said, "Hey, here's what we're seeing. We're looking at your website, and we see a list of time zones on your website. And that list includes information for Iran Standard Time and for Syria Standard Time." So they asked DocuSign about that. And DocuSign responded back and said, "Our website lists the abbreviations of all 96 time zones recognized by the international community for the sake of being comprehensive. This list of time zones does not and should not imply that DocuSign is doing business with restricted countries or individuals." So again, we've got the SEC looking around for clues, in this case, a website, and asking questions to help ensure that companies are appropriately disclosing any transactions they have with countries that are state sponsors of terrorism designated. So you might ask yourself, well, okay, fine. How much does this happen? How prevalent is this phenomena where the SEC asks these sorts of questions? Well, it turns out the major accounting firms who provide consulting to the companies that file financial reports, they tabulate each year what the SEC is asking about. Why? Because they want their companies or their clients to be able to be forthcoming and handle comments that they're going to get from the SEC, have a heads up on what the SEC is looking at. And in 2018, EY produced a summary that said, of all the comment letters that go out, 12% of them mention state sponsors of terrorism. Now, is 12% big, small? What is that? Well, to reference revenue recognition, which relates to accounting numbers, that was mentioned 13% of the time, compared to, for example, 12% for state sponsors of terrorism. Income taxes, for example, were mentioned 12% of the time. So state sponsors of terrorism is right up there in frequency with other issues related to revenue and taxes, things you might expect to get asked about financial reports. So what we find is that situation is somewhat prevalent relative to other topics. Let's take a look now at figure 1. So what you see here is a plot over time of the percentage of comment letters that reference SST. So the blue line is the frequency of SST comments, which you can see is steadily increasing and starts out at about 2% back in 2005. The red line that you see tracks instances of global terrorism. And so you might initially conclude from this graph that the SEC is doing what they should be doing. They're shining a brighter light on issues when such issues become economically more important. All right, well, let's move on from the data for a second and listen to what critics have to say about this. So critics have stepped up and said, you know what, the SEC should not be doing this. And so the Securities Industry and Financial Markets Association, SIFMA, wrote to the SEC and said, you know what, the SEC's mission is not foreign policy and national security matters. The SEC should leave foreign policy, national security matters to the government agencies charged with and possessing significant experience in carrying out those activities. So there was a criticism of the SEC doing it. They're saying the SEC shouldn't do this. Mary Jo White, who was the chair of the SEC previously, acknowledged that from time to time, the SEC is directed by Congress or asked by interest groups to issue rules requiring disclosure that does not fit within the core mission of the SEC. So what do you take from these two criticisms? The connotation is that the SEC shouldn't be spending scarce resources on things that they're not good at doing, or spending it on things they shouldn't be doing. The idea there is that it would be detrimental to other things the SEC is supposed to be doing, which in our case, what we care about as accountants would be, for example, financial reporting oversight. But there was a counter to the criticisms. In fact, Congress acknowledged that, you know what, maybe the SEC does not have the expertise to do this. So what they mandated was the creation of a special division within the SEC designed to support the review of terrorism disclosures. This group was called the Office of Global Security Risk. And so the idea there is if you create a subdivision of the Division of Corporation Finance that specializes in this, then maybe there'd be no problem. Maybe there would be sufficient resources. So given all these arguments, there's competing views as to whether the SST asking these sort of SST disclosure questions, is that going to generate problems or not? And of course, the particular problem I care about as an accounting academic is with respect to financial reporting oversight. So what we're going to do in this paper is look specifically at financial reporting oversight. So how do we do that? So what we're going to do is we're going to look at the entire collection of all comment letters that the SEC sent to individual companies over the period 2005 to 2016. And we're just going to look and see, did they mention SST or not? Are they mentioning terrorism? Then we looked at the filings themselves to see if the financial statements embedded in the filings were restated or not. So restatement means that the firm acknowledges that the financial statements initially reported a wrong number. Then finally, we look at whether the comment letter mentioned the topic of the restatement or not. So for example, if a financial statement is restated due to revenue recognition, in the comment letter, did the SEC mention revenue recognition or not? If it did, we're going to say the SEC caught the error, the financial reporting error. And so in our paper, the catching of more errors is what we mean by better financial reporting oversight. So let me give you some illustrative numbers from our paper. Let's do this. Let's start with only those restatements reviewed by the SEC in comment letters that had severe errors. Now, severe errors are things like frauds, where the stock price drops a lot when the market learns about the restatement. Among severe error restatements, we find that the SEC catches about 31% of the time, catches these errors as part of the comment letter process. Now, you might be thinking, 31%, is that good or bad? It's certainly never going to be 100% of the time because detecting frauds is really hard even for auditors. But let's take 31% as the benchmark. What we find is that if a comment letter additionally mentions SST, that the error detection rate drops from 31% down to 11%. That's a substantial drop in error detection. So why exactly does this happen? Is it because time spent tracking down SST issues comes at the expense of looking at issues associated with financial fraud? To assess this, we look at how often SEC comment letters mention core financial reporting topics. So let's have a look now at Figure 2. Here you have the blue line, which is identical as before. It shows the increasing trend in SST comments over time. However, now the red line tracks something different. It tracks the number of core financial reporting questions. There is a clear inverse relationship. That is, as SST comments go up, comments about financial reporting issues go down. So moving on from the data, you might ask yourself, you know what? I don't think it's related to SST at all. It's nothing specific to SST. It's any time the SEC is not focused on core financial reporting topics, you get a drop in error detection. Nothing special related to terrorism. So we check for this possibility in the data. It turns out if you look at all other types of comments, which include things like internal controls, we find that when the SEC asks about those issues, they also ask more about core financial reporting issues and detect fraud at higher rates. That is to say, other types of comments appear to complement or help out financial reporting oversight. SST comments, however, uniquely substitute or hurt financial reporting oversight. So to better understand this negative implication we're documenting pertaining to the SST disclosure review, we filed a Freedom of Information Act request to get a listing of the people working for the SEC Division of Corporation Finance. We use this information to figure out who is a lawyer and who is an accountant within the division. What we find is that over our sample period, the mix of labor available to conduct filing reviews has changed. It's tilted towards lawyers and away from accountants. This is insightful because the literature has already established that accountants are better at detecting financial reporting problems than lawyers are. That seems intuitive because accountants and lawyers have differing skill sets. What we add to these findings is that lawyers are more likely to ask about SST issues and accountants are less likely to do so. Together, this evidence is consistent with the shift in the labor mix at the SEC being one potential factor driving our findings. Now, of course, there are limitations to our analysis that are important to point out. So first of all, we are documenting associations. We cannot say anything causal. So for example, we don't know definitively whether the labor mix shift at the SEC is causing the degradation of financial reporting oversight. We also don't want to suggest or imply that what the SEC is doing is in any way suboptimal. For example, if the SEC put less effort towards SST disclosures, perhaps error detection would go up. But at the same time, perhaps investors would not be as confident that they understand and are investing in firms that are involved with state sponsors of terrorism countries. So the SEC has to balance these objectives with limited resources. Our paper is simply designed to establish and quantify one implication of the SEC going after SST disclosures. We do believe, however, that our findings are quite timely. There is a general push for firms to disclose more about issues beyond financial reporting, such as environmental, social, and governance issues that firms are involved with. For example, the Global Financial Markets Center out of the Duke Law School just recently published a report suggesting the SEC should think about ways to increase the transparency to the capital market regarding social and environmental factors. One of their recommendations pertains to SEC staffing structure and suggests that the SEC should make sure it has the relevant expertise in place in order to pursue issues about disclosures around social and environmental factors. Our findings speak directly to this issue in that careful thought should go into the labor that stands ready to implement the mission of the SEC. So with that, let me pause and we'll take some questions. So one of the questions that we've received is, how does the SEC decide what is important to look at and what is not important to look at? That's a great question. We can't directly see how the SEC makes decisions. So ideally, from a research standpoint, what you'd like to do is get inside the SEC and follow the actual employees around as they're doing their work and figure out where are they putting effort in, how do they decide to look at things, how do they decide to pass on looking at things. What we do know is that there are things called materiality thresholds that typically guide what the SEC does. So I guess here's an example. If we're dealing with a multi-billion-dollar company that has revenue misstated by $5, clearly it's not worth investigating, right? It's immaterial. And so the concept of material is in some sense, much easier for financial reporting numbers, because you can dollarize it, or you can put a dollar amount on it and say it's big or small. Admittedly, that's much harder to do for issues like terrorism. Like, what amount of transactions with a state-sponsored terrorism country would make you feel different about your investment if you're an investor in the capital market? Is it $1? Is it a certain amount? It's hard to tell. And so we can't tell exactly how they decide, but the issue of materiality is clearly sitting in the background. Next question I have, what has the response been to this research, and any comments or from other thought leaders or even people at the SEC? Fantastic question. I think from academics, the response is, we're at the cutting edge, if you will, of trying to quantify a different dimension of the SEC. So one of the metrics that's easy at the SEC to provide to the market is to say, well, how much work are we doing? How many filings are we reviewing? And those sorts of data are readily available. What's a little less obvious is what's the quality of the work they're doing. And so the paper and the inferences I'm providing here are actually based on Matt Kubik, who one of the co-authors, the Fuqua PhD student now at the University of Texas. He developed a metric pertaining to the quality of oversight. That is, how good is the SEC at detecting errors? And from that standpoint, what we learn is, there is a bit of a drop. What does the SEC have to say about it? This has been difficult in some sense to get direct insight from the SEC. We did try to get in front of the SEC, but as you know, government organization, their resources are limited, and so the ability to interact with academics on a paper is somewhat limited. There are other bigger fish to fry, so to say, and it is well known that the SEC has limited budget constraints. What we hope is that the takeaway from the paper is that there may be some cost to this, but we want to highlight that we're definitely not suggesting that the SEC should, for example, go hire a bunch more accountants. That may not be the answer. We don't know for sure whether the mix of accountants has actually triggered this or not. But I do think the issue is one that the SEC has grappled with for many years, dating back decades, actually. And the pressure the SEC faces is the following. There are always special interest groups, or there's Congress, there's politicians putting pressure on the SEC to do things to in their view, help the market. And the trick is, at what point does the SEC, as an overseer of financial filings, get out of its wheelhouse, if you will? And what should be the boundaries? Because clearly the SEC can't do everything. So picking and choosing what's important, picking and choosing how to get the right resources in place. I think our research is highlighting the importance of thinking about that, but certainly the jury is still out on the best way to accomplish that. And this problem is not going away because as we think about disclosures around societal issues or environmental issues, what's the limit on what firms should disclose? How much time should firms spend on doing that? How much time should the SEC spend on reviewing it? Clearly important issues. Follow-up questions. What's next? Like what do you look at next? I think what we'd ideally like to do, and we haven't been able to figure out a way to do this yet, but we've been working on it, is can we quantify some benefits? So for example, suppose that SEC oversight on terrorism disclosures is having its impact. Is it making firms actually do less in those countries? Are they investing less there? Is terrorism in some sense decreased? Are there these other benefits, or do other departments within the government who are tasked with issuing sanctions to other countries, can those departments of the government benefit from what the SEC is doing? In some sense, is there spillover? So we haven't been able to actually come up with metrics to do this well yet, but we've thought about, and we currently are thinking about ways to try to quantify the benefit side of this, because clearly what we can document, given the literature, is this cost to financial reporting oversight, but there clearly should be benefits, which is why these sorts of mandates have been pushed on the SEC about overseeing disclosures for terrorism or going forward for social issues, environmental issues. So they're clearly, clearly broad-reaching implications, and our hope is that, we can do more. One last question that tends to come up, and this is a good question, relates to auditors. So what are we talking about here? In this paper, we're ascribing the SEC as not detecting errors. But who else in the economy is supposed to be out there helping prevent errors or detect errors before they happen and before financial statements go out to investors via their filings? And of course, those are the auditors. And in our paper, we don't consider the role of the auditor explicitly, but certainly if you think about the economy, who's out there to be a watchdog so that when an investor pulls a financial statement off the SEC website, they're confident in what they see. Clearly, auditors play a role. Clearly, the SEC plays a role. And so what research might do going forward is better figure out what's the interaction between those two oversight bodies. And at what point should the SEC not have to worry so much about, if you will, catching the next Enron versus how much should the auditor do? Both clearly have important roles, but how they substitute or how they interact with each other is an ongoing issue for research, particularly given that what we're showing in this paper is that the SEC, in some sense, misses more when they do SST disclosure inquiry. So, that's an important area of research that remains unanswered in this paper. Clearly, finally, the last thing that you might want to do in terms of pushing this research forward is thinking about, how does the labor market at the SEC work, and how can one ensure that the right mix of expertise is coming in? Is there oversight within the SEC? How does that screening work? That's another layer of the analysis that ideally you'd really like to study. Unfortunately, that data is quite hard to get. Obviously, the SEC doesn't want to expose too much about what it's doing because it is an oversight body. But obviously, how the labor gets in place, how it's screened on the front end is an important element to what we only see on the back end. And so that's an important caveat for this research, that we don't want definitely to over extrapolate this to say that somehow the SEC is doing something wrong. We just want to get a deeper understanding of the trade-offs that the SEC faces so that they can make more informed choices when they decide how to use their limited budget. And they have noted they have a tough task. They have to oversee financial reporting, they have to oversee disclosures on a variety of issues, and they have a limited budget. And so it's a difficult problem that they face. And our hope is that this research provides more inputs into the discussion rather than suggesting that we have any answers. It's way too early in the process in terms of what this research does to make any definitive conclusions or prescriptions for the SEC, other than hopefully to take what we've learned into consideration as the debate continues. So with that, it looks like we don't have any more questions. So what I'll do at this point is sign off for today. We're about out of time. So let me, at this point, thank you for being here today. Please join us for our next installment of Fuqua LinkedIn Live, which will happen Wednesday, June 16th at 12:30 p.m. Eastern Time, where we will hear from Professor Yeha Wei from our Decision Science Group. Be sure to follow Fuqua on LinkedIn and to be alerted of these and other events. Take care, everybody. It was fun being with you today. I appreciate it. Bye-bye.